Silver and gold are having a sideways to slightly down week. The spot silver price appears to be closing with a slight rally, yet most likely will close just below the $16 an ounce price level. The price of gold in the over-the-counter COMEX dominated spot market is likely to finish near the $1,315 an ounce level in fiat US dollar terms. I've mentioned many times on this podcast, the physically tight palladium bullion market continues to exert upward pressure on the palladium spot price. This week, we're likely to close right around the $1,400 per troy ounce price print, another all-time nominal price record in US dollar terms. This week, we're excited to have a new guest on the show, one who gives us a longer, deeper understanding over the weakening three pillars for the Federal Reserve notes' ongoing and future value. He's coming up right after this brief message from our show's sponsor. SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. We are committed to being your trusted source for low-cost, highest quality, investment-grade bullion products. Visit SDBullion.com for more information. Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week, a new guest. He is Daniel Oliver Jr., managing member of Myrmikan Capital. Hey, Daniel, thanks for coming on our podcast.
Hey, thanks for having me.
So, Daniel, over the years, I've heard you on other podcasts, regarding precious metals and precious metal mining, investing, etc. I value your opinions and market analysis. But this latest piece you published, titled "Our Currency and Our Problem," which I will backlink in our show notes. I was hoping you might take us and the listeners through the larger points you made in this publication. You know, what the ramifications may mean, not just long-term, but even in the coming months, quarters. I suppose just to start, what is the general thesis of this recent piece you published?
Yeah, sure. So the title, "Our Currency and Our Problem," is a takeoff from a quote by Nixon's Treasury Secretary when he told the Europeans that the dollar was our currency but your problem, and that came from the sense that Americans have, and rightly so, that we've been the hyperpower, as the French call us, for the last century, economically, politically, and militarily, and certainly that was the case, especially at the end of World War II, when really the U.S. was the only game in town, and it was in that context that the current global financial system was constructed. Everyone met at Bretton Woods. The only two people who mattered really were the U.S. delegate Harry White and Keynes, the British representative. The British were weak at that point, but they still had a lot of moral suasion. But anyway, the structures, as I'm sure you know, most of your listeners know, set up the dollar as the global reserve currency. The idea was that instead of other central banks holding gold, they would hold U.S. dollars, and the U.S. Treasury, Federal Reserve, would hold the gold. And as it was set up, those countries, those central banks, could redeem their dollars for gold anytime they wanted to. And this was at a time when the U.S. had, I think, about 2/3 of the known gold in the world, and the dollar was backed 84% by gold. So it was really a financial superpower we had, because we had all the credit. We were the world's largest creditor nation. Again, we had the world's really only powerful military at that point, and our economy was enormous. So from that point to really today, the whole world, and especially Americans, have been riding on that, on those three pillars of American power, really without questioning it. And the point of the article was to show that all three of those pillars that support the dollar have really weakened dramatically. And first, if we look at military, the adventures in the Middle East, by the Bush administrations weakened, I think, Americans' resolve to go to war. I mean, these were mostly pointless adventures, didn't result in a whole lot, and were tremendously expensive, and had all sorts of damage sociologically. So I think that we're not quite as keen to go to war as we used to be, which I think is a good thing, but it's a bad thing the way it happened. Mm-hmm. And then you have Obama, who really gutted the military. I mean, he cut all the budgets. He was focusing on making it a social experiment instead of fighting wars. One of the things about military technology is it takes about 10 years to deploy new technology. So if you stop investing, you still have that momentum from the previous investments, but then you don't have anything more. And what's happened is, as all of the news is, the Russians and the Chinese are busy developing these hypersonic weapons to which the U.S. has no defense. So the aircraft carriers become sitting ducks. And what that does is it really prevents the U.S. from projecting its power militarily. So that pillar has very much weakened. On the financial side, the U.S. has gone from being the largest creditor nation to the largest debtor nation. And gold barely backs the Federal Reserve now. It's about 7% of the dollar is backed by gold. So yeah, it's not really a major factor. And economically, again, the policies that especially Obama administration put into place, but also Republicans are quasi-socialists in the way they run things, has really hurt the U.S. economy, especially relative to other countries, Russia and especially China and other places. So the U.S. is no longer dominant economically. So the point of the article in brief was that those three things to support the U.S. dollar as the world reserve currency are not there. All that really maintains it is momentum. And I didn't put in the piece, but I think it's a interesting thing to think about. The UK was really the world's major power long after the reasons for it to be so had ended. And as you may recall, in 1967, the Brits and the French tried to wrest the Suez Canal back from Egypt, which had nationalized it, and they landed their troops in Egypt under some pretext. And Eisenhower said, "Drop dead." He said, "You got to withdraw, or I'm not lending you the $1 billion you need to stabilize your currency." And the pound collapsed, and they left dramatically all of a sudden from Suez. And that was really the end of the British Empire. I mean, it ended long ago realistically, but politically that was the end. Mm-hmm. And it what concerns me is the U.S. is so aggressive militarily and financially and economically with FACT and all these things. We lord it over everyone else. And what's the real power behind that? And at the moment, I think it's becoming more and more momentum, and that's dangerous because what happens is at some point there's some event that occurs. I don't know if it'll be in the Ukraine or in Taiwan or someplace like that, and the U.S. May find a very similar situation, Suez, where all of a sudden we just simply don't have the power to project this hyper power we've had for the last 100 years, and all of a sudden the thing collapsed dramatically. So that's my concern. That was really the point of the paper.
Right. You just mentioned briefly about how we're putting all these sanctions. We're using FATCA and OFAC, et cetera, to put pressure on regimes that perhaps we want change in. Right. So, for instance, of recent, you have this Venezuela situation, which is it just shows. Kind of how, we've obviously sanctioned them for, decade plus. And Lord knows what the end repercussions are going to be. It's like the unknown unknowns that can come out of this kind of stuff.
And I think it's important to distinguish two different things. And that is, there are lots of very bad people out there and bad places, nasty countries that do bad things. And before World War II, really, you could say World War I, but really before World War II, the U.S. didn't think of itself as an imperial power. So, we didn't approve of what maybe some African dictator did or Maduro, these people, but it wasn't our job to fix it. Right. George Washington's farewell address was, look, we have a huge country here on our continent. We've got two oceans that separate us from Europe and Asia. Let's just focus on our own affairs. And we can trade with them, but let's not get politically involved. That was his parting advice. And we basically followed that advice for almost 150 years. Mm-hmm. And then we got directly involved. So to say we shouldn't be involved in these places isn't to condone what they're doing. It's just saying, the U.S. should be thinking of itself as more of a republic and less of an empire. But the example I supplied in that letter was Turkey, because what's interesting about Turkey is last summer, Turkey looked like it was about to collapse. Right? They did the classic thing that a lot of emerging countries do, which is they borrow dollar debts externally because the interest rate is lower if you borrow debts in dollars. And they used it to construct various malinvestments, lots of shopping malls and office towers, things that aren't particularly productive. They're more consumption items.
Mhm.
And that's great while the momentum's lasting. And then when interest rates go up, especially in dollar terms, all of a sudden they discover they can't pay their debts back. And then the normal situation is they default, the IMF shows up, which is, again, part of the Bretton Woods system. Western banks supply the new capital, they take the collateral,
Mhm.
of all the choice assets, and they get to economically colonize countries that way.
Right.
And there are two things about that story that are very interesting. One is Turkey's disappeared from the news. It's like, well, what happened? How come it didn't default? Why didn't the IMF show up? And part of the answer is they made deals with Iran for oil, which is one of their main imports, Russia and China. It turns out China's got tons of dollars that they don't really want, and so they're willing to lend it to people. And in fact, they're doing precisely what the U.S., the Western banks, have been doing for the last 60 years, which is they show up in places like Africa or Malaysia or Thailand, and they say, "Hey, we'll lend you $100 million or $1 billion, whatever it is, against some project which they know is going to fail," and they don't care about that because what they do is they assign collateral to things they really want. We get your port,
Right.
right?
Right.
So, like in Africa, they lent to some railroad company that had no chance of paying it back, but the Kenyans in the loan agreement surrendered their sovereignty,
Mhm.
sovereign immunity, and the collateral was the port of Mombasa. I mean, what a great prize. So the Chinese are these hedge funds call it loan to own, right? They loan money they don't really want back. What they want is to foreclose on the collateral, which are strategic assets.
Mhm.
And so the Chinese are basically piggybacking now on the dollar system because they have so many dollars, and it has a few implications. One is that China is now this competing rival empire. The fact that Turkey has so far anyway gotten off the dollar hook shows that there's a now functioning Eastern financial bloc that is competing with the Western financial bloc. So again, it's not just military competition; it's geopolitical, it's economic, and it's financial
Mhm.
competition.
Mhm.
And again, all these things. One of the reasons why if you're have a lot of dollar loans, you don't just default and walk away. It's because the whole world is in the dollar system. If you do that, you never get financing again. Well, all of a sudden, if there's an alternate place to go, right, maybe it's not so painful just simply to default and walk away. And what are the implications then for Western banks that have been playing this game for decades?
Right.
And so it really changes the dynamic of the whole global system. And what it boils down to again is we're moving from what was a bipolar world between the Soviets and the U.S., although the U.S. had all the economic might because everyone in the U.S. orbit, Europe, and so on and so forth, free economies were much, much richer and more powerful, to a unipolar world where the U.S. was the only game in town. And that was frittered away by Clinton and the Bushes and the Obamas. And now we're entering into multipolar world.
Mhm.
And that, again, it's hard to imagine the dollar retaining its unipolar status in a multipolar world.
Yeah, yeah. There's a lot of people out there, though. I mean, if you think about just in general commentary in the financial world, who just still have the unipolar glasses on. They think just because China or Russia have bad actors, this means that it can't stand up against us. Somehow we're morally better. And to me, that just sounds delusional and childlike. But that's a lot of times what I run into when I'm talking to different people. They think the dollar, it's basically its dominance is unchallenged, even with all these things that you're pointing out. It's just this idea that somehow technology or things can't change quickly. It just doesn't seem to dawn on them. I don't get it.
Well, that's the point of Suez, right?
Mm-hmm. Mm-hmm.
In the Great Depression, Britain again, the whole world was on the sterling pound standard. All the central banks kept pounds as their reserve currency. And one day, Britain just devalued it all, and
Mm-hmm.
so these central banks were bereft of capital. And one of the points I make in the paper is that the U.S. had a strong dollar policy. It did. I mean, it sounds like a joke now, but it really did have a strong dollar policy for the decades following Bretton Woods.
Mm-hmm.
And the way they maintained it was, as I mentioned earlier, European central banks had the right to redeem their dollars for gold. And the more the U.S. printed, Kennedy and Johnson printed to fund their war in Vietnam and their social programs, the more Europeans showed up and said, hey, here are dollars, give us our gold. So the U.S. gold position declined by 2/3.
Mm-hmm.
And then Nixon, it was no saint, but it really wasn't his fault in the sense that he was faced with. Actually, I've been told there was a French destroyer sailing across the Atlantic to pick up the rest of the French gold.
Mm-hmm.
So he was faced with this crisis
Mm-hmm.
of, do we give them all the rest of our gold or not? And the answer was, no, we're not going to. And the dollar, swiftly collapsed, and it was reestablished. But it had been established on the gold system. We had all the gold, so the dollar was valuable. And it was reestablished on the debt system. Like all the other countries have U.S. dollar debt. They owe dollars. They're debt in dollar terms. They need dollars to pay interest payments. So they don't pay it, they default, and we get their assets. Mm-hmm. And that is what has supported the dollar for so long in the absence of any financial wealth. So that's why these developments so undermine the status of the dollar, because if you don't need to pay your dollar debts back as a foreign country, it really weakens the international position of the dollar. And then if there's no international demand for dollars to pay these debts back, then the market says, okay, well, what is supporting the dollar? Why is the dollar valuable? And then I think what happens in non-empires and when you don't have the international reserve currency is you say, well, what's backing it? What the dollar is today, the definition of a dollar today is a unit of liability of the Federal Reserve. That's what it is. Mm-hmm. And so you say, well, what assets does the Fed have? And it used to have gold, and that's what it had. And then it had gold, and it had 90-day commercial bills, asset-backed, not general liabilities, but asset-backed commercial bills. Mm-hmm. And now they have 30-year government bonds. They have funky real estate mortgages in these weird structures. And so the answer is their assets are not just impaired; they're highly, highly interest rate sensitive. So when you dial up interest rates, which they've been doing, they really crush the value of the Federal Reserve's assets. In fact, I think they're already technically insolvent because the longer term your bond is, the more sensitive it is to rates. So the more rates go up, the more you lose in present value. So the dollar's backing is really, really weak on a financial basis. So it's really only surviving a momentum and the international demand. And my point is, when that goes away, you're not going to have a gradual decline in the value of the dollar. That's very unusual. What usually happens is, if you look over hundreds of currency crises over hundreds or even thousands of years, is it goes along and then it just crashes one day or in a week, 3 days, a weekend. So that's where we're headed. Is a sudden recognition by the market that the dollar really doesn't have a lot of value.
Now, if you look out at the currency landscape at the moment, the next largest currency that competes with the U.S. dollar is the euro. My hunch is we will see some issues there at some point, where Germany or someone else powerful in Europe wants to start dictating some terms and growing its size and scope. Perhaps is that something that you think is possible, that the euro may end up becoming more competitive with the dollar at times, or is their banking system so screwed up that it makes ours look okay?
Yeah, I don't know. I mean, I think the euro has been managed better in the sense that traditional economists just care about money supply. That's all I care about. So if the dollar, if Bernanke had $1 trillion QE and the eurozone $100 trillion QE, it's the same thing. It's $1 trillion, trillion euros. But it's actually very different. The initial QEs on the European side, again, were short-term asset-backed paper, not 30-year government bonds. There's an enormous difference if you monetize one versus the other. But Europe has tremendous problems. I mean, Italy is a mess. Italy has lots of loans to places like Turkey, which, again, I mean, you got to wonder whether the dollar's back and whose problem is it? Is it a Turkish problem or an Italian problem? And the French have lots of loans to the Italians. And meanwhile, Germany, what the German economy is making things like Mercedes, these big long-term capital items. Right. And when you dial up interest rates, the demand for that stuff goes way, way down. Everyone finances their car. No one pays for the car in cash, or very few people do. So the point is, in a higher interest rate environment, I don't know how well Germany does. So I think it's a mess. That conversation, euro versus dollar, currency strategists care a lot about it, and what's relatively better. And I don't really have a strong opinion about that because I don't really care, because both can go down in terms of gold. Right. I mean, they're both going to, and what you're really asking is which will go down against gold faster. I don't have a strong opinion about that. Yeah. But what I'm pretty sure about is that they're both going down.
Yeah, right. I mean, if you just take it back to 2000 to date, it's obvious that every currency has been going down versus bullion. So that general trend appears to still be intact into the 2020s. And so I suppose I agree with you. I could care less because I don't have much allocation to either. There are folks out there, obviously, who are hoarding cash, hoping to get, be able to buy assets on the cheap if we do have a financial downturn in the coming years. But, that remains to be seen. I want to bring it back.
By the way, I just,
Go ahead.
but just quickly, I mean, I think that's certainly possible, right? I mean, if you look at the dollar system,
Mm-hmm.
there were about $4 trillion in the monetary base, and about $90 trillion of dollar-denominated debt if you add it all up, and that debt requires interest payments all day long. And so, how do you pay back $90 trillion when you have $4 trillion of money? And because the Fed tightening, that's gone down to about $3.5 trillion. So they've actually taken $0.5 trillion base dollars off the table, which makes the potential for a short squeeze very, very high. That's what happened in 2008, and that's what usually does happen in financial crises. Is there's a huge demand all at once as everyone starts liquidating, everyone starts getting margin calls and cross defaults and all those things. They need dollars now, and so they dump everything: gold, stocks, bonds, whatever they can to pay their debts back. Because if they don't, they lose their collateral, and that's really bad. So that's why gold got hit in 2008. I don't know that happens again. In terms of gold, because I don't know how owned gold is in the West. I mean, you have to be able to dump it, and you have to have it to be able to sell it. And the managed money is probably short gold, not long. So I don't know that it happens again in gold. I'm pretty sure it happens for everything else. But I think it might. It's certainly possible. I mean, I don't know what that's a short-term question. I'm a bit agnostic on, but I'm pretty convinced that even if it does happen, we know how the Fed's going to respond. I mean, they have their toolkit, they call it, right? They have these tools. The tools, they have different tools. It's all one and the same tool: print money. That's the only tool they really have, right? Print more money. And they do it to bail out the debtors. And when they do that, gold's going to go berserk. And so again, whether gold goes down first or not, I don't know, but I'm pretty sure that either way, it goes crazy when the Fed is forced into a position where they have to respond.
And just looking out, you can see some of the government's projections as far as what the budgets are doing, how much tax revenue is coming in. It appears that the stock market is essential to tax revenue at the moment. So it gives me pause in thinking that, obviously with this about face recently with Powell, having dinner with Trump and whatever Treasury Secretary Mnuchin, being a little bit more dovish in his speak over the last month ever since the Christmas Eve crash. This gives me the impression, and I just saw recently, the San Francisco Federal Reserve's talking about, we would have done better if we did negative interest rates after the 2008 financial crisis. It would have been great. So it's like, just obvious trial balloons is what perhaps maybe the longer term trajectory, maybe where we go. Just looking out, it feels like we may end up going Japanese. We may end up having the Federal Reserve buying even more assets, even equities perhaps, who knows, and doing QE and maybe moving interest rates even to negative territories. Do you ever think of those terms? I mean, is that even a possibility?
Absolutely it is. I mean, again, the whole, I don't want to get too involved in this conversation, but basically, if you look back at constitutional law, I used to be a constitutional lawyer. I used to be a lawyer and study constitutional law at law school. There's no power in the Constitution for the Feds to charter and regulate banks. So where does the power come from? It comes from the incidental power to raise taxes. In other words, the whole argument, if you look at the old cases for the first bank in the United States, the second bank in the United States, the banking system, was all about, the banks help us raise taxes. That is their legal foundation, right? And so the Feds never let the banks go down because they fund the state by buying treasury bonds. That's their function. And so there's no chance that the Fed will ever let that happen. And so when the next crisis comes, and it will be worse than the last crisis, we know this because the last crisis was a debt crisis, and there's a lot more debt now than there was last time. So therefore, the next crisis will be worse. And all this chatter about the bank balance sheets being better, it's a bit of BS because what the bank's been doing is that they've been lending the money to people who do these crazy things. And so on their balance sheets, hey, we don't have any of this subprime garbage, but in turn, what they have is loans to other institutions doing subprime garbage. So it's the same. It's
just accounting trickery, essentially, mark-to-model basis, a whole bunch of gimmicks to make things look better than they are. Yeah,
and it's worse than that. I mean, I had a letter last summer where I explained this in gruesome detail. And on the mortgage market, for example, what they do is that they lend the money to shady people who lend mortgages to these borrowers, and then the shady lenders flip it to Fannie Mae, and Fannie Mae securitizes it and guarantees it, and the banks buy it back. And these banks say, hey, look, our balance sheets are great because we've got no exposure because it's all guaranteed by Fannie Mae. And that's true, right, in a way. Now, Fannie Mae, as you probably know, only has an implicit guarantee from the government. It says the bonds right in the front, there are no guarantees here. Everyone knows there's a guarantee because if Fannie Mae goes down, the whole mortgage market collapses. But then you're faced with this question, okay, does the Congress not bail out Fannie Mae, let the whole housing market collapse? That's door number one. Or door number two, do they print up $1 trillion, $2 trillion, $6 trillion and bail them out? I mean, that's door number two. And so, again, either way, gold as well, either in a relative sense or in a price sense, but it's coming either way. So the point is that these banks are just as pernicious, if not worse, than they were before 2008 crisis. And so the next crisis will be worse, and the Fed will have to print more money and debase the dollar that much faster.
Right. So bringing it maybe toward the short term on gold and silver, what are you seeing in those markets today? What are you thinking about gold and silver action for the year?
I think it looks pretty positive. I mean, again, as I mentioned earlier, I'm a little agnostic when the music stops, which way gold goes, because I can see both sides. I can see the short squeeze setting it down. On the other hand, I can see the Fed reacting very fast. But my understanding is that, from what I read, that the Fed was really blindsided about 2008. They were reading about what was happening in the Wall Street Journal the next day, right? and so they didn't like that, obviously. So they have moles in the big banks. I mean, they have their own people working in the banks so that they can get the information before the market does and react to it. And I think the implication of that is that they're not going to let the whole system blow up where the banks collapse. They'll print the money before anyone else knows about it, essentially. So I think the scope for gold to go down is probably pretty small because of that, because you don't have the momentum chasers, you don't have you've got short positions in it that we got cleaned out. You've got the Fed able to react much faster than it did last time, and they've used these quote unquote tools before, but it was all novel in 2008. Now they know what they're going to do, so they can react that much faster. So I think short term and long term we're heading much higher. But again, I mean, on the short term, I'm much less clear about that because I just don't know. That really depends on when and how the policymakers decide to react, and I can guess about that, but that really depends on what they do.
Sure. So I've done some studies about what we discussed earlier about how much gold filtered out of the United States after World War II. John Exeter, I believe, was the head of the New York Federal Reserve's. It's the department that basically oversaw the gold that was going out the window, essentially. And so you had a drawdown of, I think it was over 20,000 tons we had at the time, down to whatever we claim now, 8,000 tons. And he oversaw a good portion of that gold going out the door. Obviously he turned mega gold bull at the time and always warned for decade after decade about the implications of the system that we've created. When you look, as you discussed earlier, you're talking about the assets on the Federal Reserve's balance sheet, how long dated they are and how questionable they are. If you look out in the future at a point where, say, there is a dollar crisis, what are the things that the Federal Reserve may have to do in order to recuperate confidence?
Yeah, so John actually was a fascinating figure because he lived in a time when there were still people like him at big banks like Chase, which I think it was before, and the Federal Reserve. The people actually, it wasn't a dominant voice, but it was a minority voice. Now there's nobody. I mean, if John actually showed up today, he would be laughed out the door. I mean,
right.
It wouldn't listen. So the whole world's changed, and not for the better. And so my own calculations are, and they may seem a little crazy, but it's kind of just looking at history and math, and that is if you look at the central banks of the Fed back to 1914 and the Bank of England back to 1704, the gold has backed the liabilities of the dominant central bank by a third on average. Now, this was not an artifact of the gold standard. This was an artifact of the fact that for most of that time, you could show up at the Bank of England or the Fed with gold and say, I want dollars, or you could show up with dollars and say, I want my gold. So in other words, the gold came in and out of the bank under market principles, and it was the market that set this ratio, not the central bankers themselves. And that number, interestingly, the Federal Reserve since 1971, since Nixon took us off the gold standard, is 28%. So it's actually not that much different in the gold's post-gold standard era. Now, since 71, the ratio has become much more volatile. And where it stands today is around, I think, 7.5%, some number like that. And so that is, and the rest of the balance sheet are these funky mortgages and long-term government bonds. So I think the market is going to force that ratio back to a third at least. That's the equilibrium level, and that is at a time when the balance of the assets were short-term commercial bills, not 30-year government bonds. So in fact, that ratio I think will go a lot higher. And that's how you get to gold prices above 10,000. And that sounds a little crazy today, but again, it's just looking at the Fed's balance sheet and saying how big is it, and what does 10,000 mean? It means about 2/3 backing by gold. And in 1980, that number got over 100%.
Right, for a long time, not just for a minute either. That was like it lasted.
100% lasted about plus 100% was about a week.
Okay,
and that was and the equivalent today would be about $22,000 an ounce. Okay, so that's not the equilibrium level. That's sort of the max craziness it got to, and then it corrected back to lower levels, which I think would be more today's terms, more like $8,000-9,000 an ounce. So that's sort of what the equilibrium would be. But that assumes that the Fed's balance sheet doesn't change in size, and that's not a good assumption, as you pointed out. When the crisis comes, and they need to print dollars fast, and they print them again not because they're insane. They're doing it because all their friends at the big banks and the big PE firms are blowing up, and they need the money. Goldman Sachs needs the money. Chase is going to need the money. AIG needed the money, and so they just can't imagine a world without these institutions. Right. And so they print the money on that basis, and so it's hard to imagine the Fed's balance sheet not doubling or tripling again, and all those numbers I just mentioned then double and triple in size. And so it's the numbers gold is going to go to when the Fed, when this whole system unwinds, is going to stun people. And this isn't Weimar Germany stuff, right? I mean, gold went from $35 an ounce in 1971 to $875 in 1980, so in 9 years. And the world didn't collapse. They didn't have wheelbarrows and people weren't in the street, begging for food. I mean, it just people adapt and they will adapt again. And so I don't think we're heading towards Zimbabwe yet. Right. But the point is, you can imagine easily a 90% decline in the value of the dollar, and that's just the 1970s.
Yeah, I mean, if you just look at 1933 and 1934 in general, that's a 70% devaluation versus gold, and that was too low a price, and it was too deflationary a price of $35 going from 20 bucks, right? So this has happened, and this, by the way, I've even gone deeper. Like you go back to like the greenback era, and the craziness that happened with the gold price back then, going from 20 bucks to $160 in like 1870. I mean, this has happened multiple times in our history. Happened. Yeah, that's the point, and people adapt. So I mean, it sounds crazy to say gold's going to 10, 15,000. I know.
But the point is that history tells you it happens, and that again, like a lot of people rich today won't be then, and then people who are clever and make some money along the way. But the world won't end, the country won't end. It's just one of those things you live through. So that's coming, and what it really is. Again, if you go back to pre-1933, the way the market would stage a run on central banks is, again, you could show up at the bank and say, here are my dollars, my gold, or my marks, or my pounds, or wherever they are. And so the central bank would have to disgorge gold, and they'd run out of gold, and then they'd devalue the currency. Today, you can't do that. You can't go to the Federal Reserve and say, here's $100 million, give me gold. But you can go to the coin store. Right, it's the same thing. So I want to redeem. I don't want these dollars anymore. I want to get gold. And I got to get out of I want to get out of the system, and that's how you do it. And so the way the market stages a run on the Fed today is by raising the gold price. That's how it does it. And we haven't seen that yet because the 2008 was a commercial bank crisis, and because of what the central banks have done to their balance sheets, the next crisis is going to be a currency crisis, a central bank credit crisis. And again, the way gold's function is to balance balance sheets, and gold has to go to a price that's going to balance the Fed and the ECB and the BOJ and the Bank of England. All those balance sheets will get balanced, and the way they do it is the gold price goes to price that balances them, and that price again today is up around 6,000-8,000 under normal circumstances. And in a crisis, it can go beyond that, and if they raise their asset level, it can go beyond that even. So it's when it happens, it'll happen fast, and it'll be quite dramatic. I should point out that 10-year devaluation in the 70s, it really happened. There were really two parts to that, right? It was 71 to 73, and then I don't know, 78 to 80. It wasn't a
Yeah.
whole decade. There were two.
Well, similar
Uh,
to this that we were seeing, 2000 to 2011 roughly, with a little bump in the road.
right.
And now we've been consolidating. And I would argue derivatives have obviously played a part in stretching this out. I mean, this is a more complex gold pool that's being run. But what we have
Right.
here is, a game of, a lot of fractional reserve fake gold versus the actual thing, the real stuff. And where's the real stuff been going? East,
That's right.
obviously.
That's
So
right.
here we are with a more complex show. But it is happening similarly. I suppose you could say there's some rhyming going on.
Oh, absolutely. I mean, yeah, I mean, I'm writing a book on the history of credit bubbles when I have time. It's almost done, and you can trace this stuff back 5,000 years to Mesopotamia. There were 28 debt collapses in Mesopotamia, and there, there's well recorded. The first well recorded interest account of a credit collapse was in Athens of 594 BC. There was a panic in Rome in AD 33. I mean, again, this is nothing new about this. It's all historical, and it happens exactly the same way each time. And so the part of the book I'm working on is if you understand history, you understand what drives these things, you can then understand the context in which you're in, and then have a pretty good sense of what's coming next. And again, I don't have precise timing what's coming next, but we are, I think, past the apex of this particular credit cycle with the Fed raising rates, and you see stress in the market, you see stress in the levered loan market, all the peripheral markets having stress. That's how these things always start, whether it's third world countries or subprime or levered loan or whatever it might be. And don't forget the real estate market in the U.S. started melting down in mid '07, and Lehman doesn't come till the autumn of '08.
Right.
So I think that's sort of where we are. We're sort of in there's a bit of smoke coming out. There's no big deal yet. We're sort of in the summer of '07, maybe the spring of '07. So I don't think we're imminently at Lehman, but we're approaching it, and it might happen faster because everyone is more attuned to these problems, and so it might accelerate than we think. But I think that's where we are.
I'd be remiss if I didn't ask you a little bit about your take on silver. I presume in this context that silver is just going to do the standard thing where it kind of, it follows gold, but like not super sharp, and then it goes aggressively and exponential at some point, kind of the spike and dive metal that it typically is.
Yeah, so my view on silver is a little more complex than that. If you look back at monetary history, silver was always a transactional metal, right? You went to the market with your silver. You didn't go to the market with gold because who wants to make change for gold coins? You don't buy a banana with a gold coin. I mean,
you buy a house with gold, or you buy a business with gold. Yeah,
right. So you buy your ship, or you ransom your king back. So gold is the money of capital, and silver is the money of goods, essentially. And so if you look at the Great Depression, when the banks blew up, capital had big problems. So gold did very well. I mean, it was illegal in the U.S., but they raised the price, and actually, U.S. you could own it. Silver did terribly, and the reason is because the dollar as a transactional medium never had any problems. It got true strong if anything happened. Whereas in the '70s, you had a capital problem. The banks didn't fail, but if your money was in deposit in a bank, it wasn't doing very well because of inflation, and the dollar was not a good medium to go shopping and keep a little bit of money in. So the silver went crazy compared to gold. And so it's a different bet. It's a bet on whether the credit collapse will be inflationary or deflationary. Right. And I think it's important to understand that. I think I'm almost positive that this credit collapse will be inflationary, and so silver will outperform gold because of that reason. But that's how I think about it, and I think it's possible that they could. If the Fed blinks, right? If they say no, we're not going to go down the Weimar route, the '70s route. We're not going to put the money. We're just let the banks blow up. Then I think silver might have problems. Gold would go crazy. Silver might not. I think the chances of happening again are almost zero. But it
I mean, if you just look at how weak Powell has been in the last month, it's the answer is zero. I mean, these people are
almost zero. Almost zero.
I agree. It's almost zero. You never know, obviously. So.
But also, it's important to know that the point of gold. People say, "Well, if I have gold, I can't use it in the crisis because I'll get shot." And people steal. And the answer is, well, that's partially true. I mean, the point of gold is to preserve your capital through the dark times. So when things settle down, you've got capital to restart life with. It's not really to buy groceries when things are really bad. And I was at a coin store here in New York several years ago called Stacks, which is an institution, and there were some guys. I think they were Iranian. and they had stacks of gold coins. I
Hmm.
think they just got off the boat and they were sending their gold to, I don't know, over a laundromat. I mean, I don't know what it was, but they got their capital out,
Hmm.
and they're restoring life. And that, I mean, again, I don't expect, it doesn't mean Americans are going to boat and go somewhere else, but it just in terms of the credit cycle, gold keeps your capital through the cycle, and then you got something when the system reestablishes itself.
Yeah, right. I think all our investors out there who've been in this game for a long enough time understand that it's maybe the short term guys who don't get that
Right.
the bigger game afoot. But I really, really do appreciate you coming on today, Daniel, and wanted to give you a plug. I mean, how can people who like what you had to say, how can they follow you? How can they get your research?
Yeah, so I do a letter, a monthly letter, bi-monthly now letter on my website. It's www.myrmikan.com, Myrmikan, and it's free to sign up. And again, when I have time, I put something out. But it's been a fun intellectual journey, and I think we're really, after 9 long years, I've been at this business, which is very long for most people. But I got into it right after the last credit collapse
Hmm.
when I did my own study, realized what the hell was going on, the context I had been missing.
Hmm.
And I think we are towards the end of this credit cycle, and rapidly, the funnel will start happening for gold investors, I think, very, very soon.
Well, Daniel, thank you so much for coming on this week, and hopefully we'll get to talk to you soon.
Great. Thanks so much.